Barron's associate editor Andrew Bary is back with the outlook for real estate and some smart stock picks. Andrew, thanks for coming on.
Glad to be back.
So Barron's cover story this week looks at the changes in the real estate market that have made it more difficult for a significant share of Americans to afford a home. Break that down for us.
Well, it's been a double whammy for home buyers. You have higher prices up about 15% the past year and higher mortgage rates, which are up to about 4.5% from 3% at the start of the year. So you have higher prices, bigger down payments, and higher mortgage payments, which could chill what's been a very hot housing market.
So while obviously that's tough for the buyer, it's great for the seller. Let's remind homeowners, however, that double-digit price appreciation does not go on forever. Economists call it recency bias. We call it don't get too excited about this. It won't last forever.
Well, that's true. I mean, it's unlikely that you're going to see 15% plus appreciation for the rest of the decade, but it's conceivable that real estate could have a good decade. The conventional wisdom is that stocks are a better investment than real estate, but in the 1970s, an inflationary period, real estate did a lot better. It's possible that could happen again.
But amidst all of this, home builder stocks are selling at crazily low valuations compared to everything else in the stock market. What's going on there?
Well, the business is doing great, but investors fear the good times will not last. The home builders are like the worst group in the stock market this year, down around 25%, and valuations have rarely been lower. They're trading for about 4 times earnings, near book value, and their balance sheets have really never been better. They're buying back a lot of stock. So the financials look very good for home builders right now. Investors just fear that things won't stay this good for long.
Hi, Andrew. It's Ben Levison. Toll Brothers seems like it could be really well positioned for the new ways we're using our home in the post-COVID world, but the stock's not getting any love. What's going on?
Well, Toll is the most differentiated of the major home builders because it focuses on the high end. Its homes sell for about $1 million on average against $400,000 for a lot of its peers. And it sells a lot of amenities to buyers, including mother-in-law suites and home offices and fancy kitchens, on which it earns good margins. So Toll is really differentiated. It's trading for about 5 times earnings and just a small premium to book value. It's a very good company. It looks very cheap right now.
So, Andrew, I just want to look at the other side, the not million-dollar houses. You wrote about Lennar. What's the opportunity you're seeing there?
Well, Lennar is one of the top 2 builders in the country, along with D.R. Horton. And one thing that Lennar has going for it, it plans to spin off its non-home building operations later on this year, which could be worth a quarter or more of its stock price. There's also a secret way to play Lennar, which is its Class B super voting shares, which trade at about a 15% discount to the better-known Class A stock. You get a better dividend, lower PE on that, and ultimately the 2 classes could be combined one day. For individual investors, the Class B stock, trading around 69 now, could be a good opportunity.
Andrew, why is Home Depot stock down 27% this year? Lowe's is down 21%. I thought we were all frantically working on our homes right now. Do you still like home improvement? Do you still like these stocks? Which one is your favorite?
You know, I think home improvement stocks are some of the better values in the entire retailing sector right now. It's kind of a mystery. I mean, investors just don't think the good times are going to last, that higher mortgage rates are going to bite and the housing sector is going to slow. But Home Depot is the industry leader, and Lowe's is quickly making up ground against it. I might lean toward the industry leader, which is Home Depot. It's got a 2.5% dividend yield. It's got better locations and better relationships with contractors than Lowe's does. And it's a really high-quality company now trading for a below-market multiple.
Andrew, one more quick question on the home builders. Their contracts actually lock in those profits for a while into the future, right?
Well, right now, I mean, the earnings for 2022 are kind of baked in, given that contracts were signed now and in the last couple of months are going to result in homes being delivered later on this year. So effectively, their profits are locked in for 2022. They're trading for about at or below forward book value, and book value has often been a floor underneath these stocks. If you get a decline in mortgage rates, these stocks really could roll.
Thanks a lot, Andrew. Appreciate it. Great to have your insights, and sometimes you see things the rest of the market does not.